But now in 2025, especially by the end of 2025, this is going to be a major factor. Check this out. Paying off collections will not increase your credit score. Let's talk about it. So, starting in 2025, paying off collections can improve your credit score and be removed as well. Okay, so again, this is going to be a major change in the time frame. Now, before 2025, obviously that wasn't the case. You still could get this done, especially if you. Hello everyone, my name is Calvin Russell, CEO and founder of 850 Club Credit. Hope everyone's doing well today. Today we're going to talk to you all about 5 credit score lies that you've been told, okay? You probably never even knew that they were lies or bad information. Don't worry, we're going to clear that up today. Let's get going. So the question is, do you know what really affects your credit score? Okay. Think again. All right. Some of the most common advice that people give you, it could be friends, family, or something that you probably heard on YouTube, might be misleading you. And the question is, are you falling for these credit score lies? Let's find out. So, lie number one, checking your credit score hurts it. Okay. Let's clear some things up. All right. So, checking your own credit score through a soft inquiry does not affect your score at all. Okay. So, you got to understand that. So, essentially, most of the time that people need your social, expect it to be a hard pull in most cases, unless it's like the last four or the last six. But in most cases, they're not even going to ask you for your credit score, which in that case, you already know is going to be a soft pull. Only hard inquiries from lenders when you apply for credit can temporarily lower your score. This is like obviously for a credit card, for an apartment, for a mortgage, for an auto loan. Those are the most common things. Now, regularly monitoring your score is going to actually be a smart way to stay informed and catch issues if there are some things that you need to be on top of early. Lie number two, closing old accounts is going to increase your credit score. Okay, let's get this cleared up. So, closing old credit accounts can actually lower your credit score by shortening your credit history. A lot of people don't know that what actually ends up making your credit score, a small percentage, but still a percentage of what makes your credit score, is called average age of accounts. Okay. The average age of accounts is essentially going to be a key part in improving your credit score or keeping it stagnant, or in this case, lowering it, because now you're throwing away that history. Now, that history doesn't automatically just fall off as soon as you close the account. It usually takes about 7 years. However, and whether the account is open or not, old history does not has a lower value or impact to the credit score overall. But a longer credit history is going to demonstrate responsible credit management to lenders. When you say, "Hey, I've been paying this bill on time for 3 years. I've been paying this bill on time for 5 years," they like to see that, and the algorithm does as well. You want to keep older accounts open, especially if they have no annual fees, to help maintain a strong credit profile. Now, lie number three, okay? A lot of people don't know this one either, and that's carrying a balance improves your credit score. It does not. Now, I'm not saying that you can't carry a balance. There are things that you're gonna do just your natural, normal way of kind of, just kind of using credit. But you have to understand that it will affect the score. Real quick, if you're looking for a cheap account that's going to help you build your credit score every single month, then check out this account. It's only $10 a month and it reports to all 3 credit bureaus. Scan this QR code to learn more or click the link in the description below. Now back to the video. So number one, carrying a balance on the credit card does not help your credit score, and it only is going to cost you more interest depending on of course, your card terms and things of that sort. Okay. Number two is that paying off your balance in full each month shows not just responsible financial behavior, but again, everyone's balances are going to be a little bit different. Everyone's uses are going to be different. Everyone's card is going to be different. So, of course, if it's maxed out, just focus on obviously making those payments on time, bringing that down as well. It may be a business credit card where you're not too much concerned about the balances or the utilization, or it may not be in your name altogether. That's a little bit different. But in this particular case, you just want to get in the habit of doing this. And you can also pay multiple times within that month as well. But of course, low or no balances keep your utilization low, which is crucial for a healthy credit score. Another thing you could do here as well too, especially if your balances are very close to your limit, over your limit, or at the limit, you can most definitely ask for a credit limit increase, not so you can use more, but just so you can create more separation between that balance and, of course, that limit, which, of course, is going to improve your credit score along the way. So, lie number four, okay? Now, your income affects your credit score. You'd be surprised how many times I've heard this, especially when I sold cars at the dealership. I was there for about 6 years. I sold for about 550 cars in less than 6 years during that time frame. And a lot of people did not know that their income was not on their credit report, or they thought that it impacted it. So if they made more money, that it would essentially give them, a higher score. It does look better on an application. However, it has no direct impact on the actual score itself, and your income is not even on the credit report in general. Okay, but your income is not a factor used in calculating your credit score. Credit scores are based on your payment history, your credit utilization, as we mentioned. And if you don't know exactly what utilization is, this is the basic formula is balance divided by the limit is going to be your utilization, and that's going to be a percentage. Okay. You want to be somewhere between 7 to 10% utilization. So, an easier way to do it is just look at your limit, multiply 10%, and you want to be around that number. That doesn't mean that you can't use more than that. That just means that if you are using more than that, your score is going to actually start to lower. Okay. The length of credit history, we just talked about that, where essentially your average age of accounts. Okay. And the fact that you have accounts open and of course obviously making the payments on time, things of that sort, that's going to show that you've been doing it, the longevity. So 5 years, 8 years, 10 years, that's what they're looking to see. And of course some other factors as well, like a mix of accounts and of course new accounts as well, which you don't want to have too many new accounts, because a lot of times some people, they'll add like 5 accounts to try to improve their credit score. And while they're doing that, that's the positive thing. But the negative thing about that is that it's resetting that average age of accounts. You're getting too many new accounts as well. But you do want to have a mix of accounts. That's going to naturally happen. Real quick, be sure to download our free ebook today. All you got to do is scan this QR code right here or click the link in the description below. Now back to the video and just throughout your course of life. If you get an auto loan and if you end up getting a credit card, those are two common things. There's only two type of accounts that can be on your credit report anyway, and that's going to be revolving and installment. Okay, installment is an account that ends in the word loan. So when you have mortgage loans, auto loans, student loans, or personal loans, those are all going to count as installment accounts, which again, people end up getting usually an auto loan or student loan or sometimes even a personal loan throughout their natural course of life. Okay, especially living in the US. Okay, and then of course the other type of account is going to be what they call a revolving account. Usually those are going to be credit cards because the balance always revolves, whether you use the account or not. It's essentially something you have access to, essentially like a line of credit. And then, of course, you swipe the card, you use it, you pay it back. That's how simple that's going to be. Now, while income can impact your ability to repay debt, it doesn't directly influence the actual score itself. Again, it's just more of an application factor. And lie number five. Now, this is technically not a lie. However, and I'm only saying this because the times are changing, okay? So before 2025, this was a major thing. But now in 2025, especially by the end of 2025, this is going to be a major factor. Check this out. Paying off collections will not increase your credit score. Let's talk about it. So starting in 2025, paying off collections can improve your credit score and be removed as well. Okay. So again, this is going to be a major change in the time frame. Now, before 2025, obviously that wasn't the case. You still could get this done, especially if you had an agreement with the collection company and they decided to go ahead and remove it. But again, that was up to them. Or another way of looking at it is, even if you didn't reach out to the company and they decided not to remove it from your credit report, you made that payment without them, and they say, "Hey, it's still going to stay on your credit report." That still being on your credit report, the collection itself, what was affecting the score. But now in 2025, with the FICO TNT mainly, okay, it's a new algorithm that's coming out, and a lot of banks and financial institutions, including credit unions, are going to be changing over to that model. Especially if you're looking for a home, they're going to be forced. They're switching over to that model. What does that mean for you? That means that if you're inches away from home ownership and you have a collection, then paying that collection will improve your credit score in 2025. So now only older credit scoring models, like the ones that's have been out for years, when you go to the dealership, if you try to get a house early in 2025, they're still going to be using the older credit models. They're still going to count the paid collection against your credit score, whether it's paid or not. Okay, I do want to say that, whether it's paid or not. But you always want to verify with the collector if they'll remove the account from your credit report after payment if you do decide to go ahead and have it paid as well too. So keep that in mind. It's not a luxury. It's more of a, it's a nice gesture for them to remove it because they don't have to remove it. Technically, it being on your credit report is accurate because it met all the standards to be on the actual credit report. Okay. But again, you're going to see the benefits of this in the end of, by the end, I would say third to fourth quarter of 2025. Thanks for watching, and we'll see you guys on the next video.